Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Steve Levely from Ackroo. Ackroo trades on the TSX Venture Exchange under the symbol AKR, and it also trades on the OTC under AKRFF. The company is currently trading at 7 cents with about 115 million shares outstanding, or about an $8 million market cap. I'd now like to hand it over to Paul Andriola.
Trevor, thanks a lot. Steve, good to have you back. It's been a little while since we last spoken.
Yeah, good to see you, Paul. It's been almost exactly a year.
Yeah, I think we bumped into each other at the conference about a year ago, if I'm not mistaken. So good to see you again. Ackroo, a name that we've talked about in our circles a fair bit over the last little while. Always good to get caught up, to see what the latest and greatest is. So you've got a presentation. I'm going to hand it over to you. Why don't we go through and remind everybody what Ackroo is all about?
Great, yeah. I did a few updates since the last time we kind of went through this, so this gives people a bit of a refresher as to not just what the business is doing, but what's kind of happening in the near future. From a business standpoint, the name Ackroo comes from accruing things, but really the focus for our business was always to be a consolidator. We're an acquisition and earnings story at Ackroo. So it's all about acquisitions and earnings here, where we're acquiring businesses in the space that are both competitive and complementary. But the whole goal for Ackroo was to be that consolidator of the small businesses that do gift and loyalty, but eventually we consolidate ourselves. So to kind of gobble up the smaller players that are doing what we're doing, and then eventually present ourselves as a conglomerate to something bigger and better. And we're getting closer to that tipping point as a business. Our mission's been the same, where, again, to consolidate and simplify and improve, because we do it across marketing, payments, and the point of sale industry, primarily the marketing business, which is our gift loyalty business that we focus on. But what we do is, unlike the Constellation softwares of the world, when we buy businesses, we consolidate them, we move them into one operation. So it's one single operations, not multiple technologies. So one tech stack, one operational footprint, and that's where all the earnings and stuff come from. And that allows us to kind of get the quick earnings into the business. And then we do it with a technology first, services second kind of approach, which means it's about our technology. It's not about becoming a marketing services company and charging services. It's a SaaS business. We have a technology. It's a self-serve platform. Use the technology, which is good for scale. So that's how we've gone to market. And we've done so across our Ackroo marketing product, which is gift and loyalty, payments, which is debit and credit. And then we've bought a couple POS companies, one of which we've divested, the other ones which we've kept, one for automotive, one for golf. The golf course one we actually divested of. And then we also resell a product called Clover, which you'd be used to seeing out in the marketplace, those white terminals that are out there. So we do sell a Clover POS as a part of our reseller agreement with Pfizer. So what we look to the market to sort of be a market leader in is we are a consolidator. We think we do it really well. We've done a lot of them, but it's really about optimizing operations. How do we take our business and our operations and take smaller break-even business and optimize them in short order? So that's really the magic of what we're doing here. We try to be as innovative as possible with our technology because we're kind of Frankensteining the tech together. So taking features of acquired assets, building them into our core product, move those clients over, shut off the old tech, rinse and repeat. We then have to integrate that platform into the whole ecosystem of gift and loyalty. And we kind of do it across 4 different verticals today: gas stations, so petroleum and convenience, hospitality, restaurants, quick service, table service, automotive, and retail. We've done a lot of purchasing over the years because, again, after I took over in 2014, that was my theory. I first joined the company in the first year after it was acquired back in 2012, where I was the head of sales the first year and then took over sales and marketing the second year. But I really quickly learned, even though we had doubled the business organically from about a $500,000 business to $1 million business in that period of time, that it was really fragmented. And to get big, especially while being public, the acquisition path was the path. So we've spent the last 10 years now acquiring businesses. We've invested over $11 million of cash, and we've issued 44 million shares to do that. We've added about $7 million of recurring revenue during that period, but we've divested of one, so add about $6 million of recurring revenue. So if you do the math, today we're a $6 million recurring revenue, a $1 million one-time revenue business. We are a $7 million business. So that little $1 million business we had that started before the acquisitions was really all grown through acquisition. Our organic business has kind of offset any attrition that's come through the acquisitions and to maintain the portfolio. But all of our growth story is the acquisition growth story over the years, going from that $1 million business to $7 million business over the last 10 years. We like to think of how we're a bit different, has been our focus. We've gone after that sweet spot of small to medium-sized providers in our space. So less than $3 million, which is less than half the size of Ackroo. So we've really focused on those smaller businesses that there's not a big appetite for purchase. When they go out for sale, there's not a lot of buyers for them. Not a lot of people buying $1 million businesses because it doesn't really move the needle for them. But for us, it's been really quick and easy for us to tuck them in, take a break-even business and turn fast profitability. So we focus on this small underserved market of acquisitions, and there's plenty of it out there and more to do. We've got stability now. The big turning point for Ackroo is at the end of 2017, we turned profitable. We became EBITDA positive, and we're generating a solid margin. At the end of Q3, we reported 21% year to date. That number is only increasing since then. So we've done a really good job on generating a strong EBITDA margin for the business. So we're stable. We generate cash here. We know how to actually do that. So we've crossed the chasm of profitability, and we've been doing a better job quarter after quarter with that. We do have a bit of breadth of offering because we have marketing, payment, and point of sale, and we're both in-store and online. So we're doing a lot of things to a few different verticals. But the things that I think that are strong and great about our business is it's very predictable. 87% of our revenue is recurring. So even if we have a tough quarter, it's very predictable. I already know today within 10% what our final numbers are going to be because of that recurring revenue business. And it's highly profitable. We're almost a 90% gross profit business. 89% of it because it's a software business. We don't have a lot of cost of goods sold here. We're not a product company. We're not a hardware company in any way. We're just a software company. So very high gross profit, which again, plays into profitability. Being public early days was not the best. It still hasn't been great through these current times either, but it does help for M&A. From an acquisition standpoint, if you are going to issue paper in the deals, if you're a seller, you want liquidity in that paper. You don't want to be locked up in another private deal that you're not even running yourself. So us having our public paper does allow us to kind of get creative in deals because some of the owners that do sell are looking at the price in which we're offering and they want some upside. So the upside in our stock, which is fundamentally liquid, is appealing to them. So it's actually been an asset for us. We've done now 13 deals over the last 10 years. We pretty much do 1 or 2 every year. And we've kind of maintained a pipeline of about 20 targets at all times, kind of like a sales funnel. You close one, you add another. So we've been maintaining that, and it still sustains itself. We've had consistent growth throughout the years. We've had a couple flat years through COVID from a revenue standpoint, but for the most part, there's been consistent growth. We believe the valuation is low, so much so that it's below even what we're purchasing at our current trading price. And this is all based on a March 1st trading price where the stock was 8 versus 7. And we've been a very under the radar, especially over the last few years. We haven't spent much time on awareness. We haven't been a big promoter of our business per se. We've been really focused on the fundamentals of the business, especially over the last few years, because a part of what we've agreed from a leadership standpoint is over these next 3 years and now 2 years left is we are going to pursue strategic options. I talked in the beginning about, the first mandate was to, consolidate as much small, medium-sized businesses as we could. Well, we're now starting to have active conversations about strategic options for the business so that we will pursue a transaction over the next 24 months. And so that's a very active and live thing that I've been open on investor boards, and our whole staff is aware of this, that we are aggressively pursuing strategic options for the business over the next 24 months to get an outcome for ourselves and investors. Some financial highlights about the business. We still, even though COVID did hurt us through those years, we're kind of trying to climb out of the retention side of it. We still have a 90% retention business. So, and with gross margins high and recurring revenue high, it affords a safe kind of business. We have a keen eye on things like revenue per employee. I believe that the higher the revenue per employee in your business, the higher you're paying your staff, the more profitability you have. So I think it's a really important metric. So we talk a lot about that when we do our headcount management. So when we think about our business, it's a lot about revenue per employee. We finished the year with $200,000 of cash and then our full line of credit. So called about $1.8 million of accessible cash that we finished the year on. But a good news story for us, even over the last 12 months, since the last time I did one of these videos, was our debt to EBITDA ratio went from 3 to 1 a year ago down to 2 to 1. So we carry about $3 million of debt, but we have more than $1.5 million of earnings in the business today. Our financials get released in the next month, but we got past that 2-to-1 ratio of earnings to debt. And we're going to keep working to chip away at that. And especially at a time when debt is expensive, and it can be limiting for a business, we continue to kind of grow those earnings to get those ratios back in check. And this is now our 6th consecutive year of being EBITDA positive, with closing the 13 M&A deals. Here's a snapshot of our revenue growth throughout the years. You can sort of see steady bumps. Again, I took over in 2014, and we put a lot of focus on some top line growth. We had 2021, the first year of COVID, where we were flat, sort of sustaining our business. But we've managed to continue to maintain growth in our business. Again, heavily through acquisition, but it's continuously been growing for our business. But the main story has been earnings. Our earnings story is going from a business that when we first started was burning a lot of cash and capital, to 2018, we actually turned the corner on profitability. Again, 2021 was a tough year for us, not just for revenue, but costs. But we bounced back, and we're going to see continuous earnings growth for the business that we're very proud of, that we continue to kind of manage a very lean, mean business. I did a recent press release about our acquisition of Simply Connect, where in a year's time, that business, we purchased them, they were losing $500,000 a year when we bought them. And now we've gone from them losing $500,000 a year, where we made 16% EBITDA last year on them as we worked throughout the year. And now we're making a 60% EBITDA on the business this year. So it just shows you what we can do by turning that business around into our infrastructure, into our operations. And we continue to do that across our other acquisitions. Here's a list of all of our deals, and also outlining, the recurring revenue that was added and the multiples that we paid. On average, we pay about 2 times revenue. And the reason why I say revenue, not on multiples on their earnings, is because we look at how it normalizes into our business. So a break-even business, or even a cash-losing business to one business, we look at it with regards to when we can integrate into ours, can we get at least a 50% margin on that business so we can get a 4 to 5 year payback? So within 12 months' time, can we buy that business for 2 times revenue, give or take, and actually put it into our business within 12 months' time and generate that 50% plus gross margin to the business, or net income, sorry, that allow us to kind of get that 4 to 5 year payback. And with every deal, there's strategic stuff. We want to, add in different, complementary pieces or different strategic pieces. We added things like payment and point of sale because those partners became competitors of ours. So the industry is not just consolidating by segment, it's consolidating by full offering. So we've continued to expand that way while also thinking about the US. Here's a bit of our inorganic story, or our strategy, if you will, and getting that payback and normalization within 12 months. But again, it's a lot of the focus on the small. How do we, consolidate the smaller businesses that are just, it's hard for them to find scale, where we can bolt them in and get a bit of scale out of their business through us. Our approach is really on a sales perspective organically. We do direct sales as a secondary option, but our primary is, as we buy portfolios, how do we cross-sell them? How do we cross-sell a gift card merchant with loyalty? How do we cross them with payments? So it's a cross-sell of acquired merchants. So every time we buy a portfolio, we bought a big portfolio of merchants in December of Giftfly. They had thousands of merchants, very small revenue, $500,000 of revenue, but actually more locations than Ackroo has. So can we take those locations, put them into the Ackroo environment, cross-sell them, and go from $10 a location to the $100+ a location that we make today? And that's kind of what we do on the acquisition side of it. We really have one core platform in our marketing platform, which runs loyalty and gift cards and promo all in one platform. And we've been very focused on the North American geography. We haven't stretched our wings into foreign markets yet. We know competitors have done that, but for now we've just had enough sort of place to play through North America. That's what we focused on. Then lastly on this slide is kind of where a bit of our mix is. You can sort of see we're kind of 1/3 US, 2/3 Canadian today, because our last couple acquisitions were US based. And we're still heavily marketing with just a bit of payments and a bit of point of sale from a revenue perspective. Our organic business, how do we make money? There is a setup fee that we get for setting up the platform, whether it's custom development and cards and what have you. They'll pick a monthly subscription plan with us. We do get variable subscription revenue through payment residuals and point of sale residuals. And there is some other product revenue. But if you look at like last year, what we paid cost to acquire organically, we paid over $2,000 per location organically, but inorganically we paid about $1,000. So if you do the math, it's half the price for us to purchase inorganically than it is organically right now, which screams why we're also thinking inorganic is the path in our industry. Not only is it instant and you force your product to expand faster, it's more economical for us. So at this stage, it's been the more economical choice. So we keep further investing there. Several times we've thrown money at our organic business and put a lot of money and energy into there. We haven't seen a big outcome. Within 6 months, we ratchet back. Where what's been proven and worked well for us is the acquisition investment. It continues to sort of pay well for us. Organically, the fundamentals are still okay, but we haven't really unleashed bigger success there as of yet. The good news is we can consistently see our revenue per location is growing, whether organically or inorganically done through this whole cross-sell, upsell. We continue to get good, solid revenue per location per year. And on average, we model based on a 7-year average, but you'll see some of our case studies coming up. We've had merchants with us well beyond 7 years. We have them for the whole 12 years we've been with us, and even the 8 years that MoneyBar had before us. These are some of those examples, like an Automotion who's been with us for 7 years, only last year added payments. It was a very easy justification for them to switch over to us. But after 7 years, 6 years in, they finally added a secondary offering from us, providing them much more value to their business. Being around the world, it's been with us since 2012, but MoneyBar actually had them 8 years before that. So this is a 20-year-old client. It just shows you how long merchants can stay using the platform, and they use gift and payments with Ackroo and loyalty with Ackroo. So it shows kind of the lifetime value can be quite long in a software business like ours. Initially, in the past, we were a gift card loyalty play. That was the whole approach to the market. We had all these partnerships in payment and point of sale and marketing and data, and then we're like, we can't just trust on partnerships. Let's start doing these things ourselves. So we bought a payments company, bought some point of sale companies, developed marketing components. The last piece of the puzzle for us is really data. They say data is the next greatest resource, more important resource than even oil nowadays. And so we're trying to really embrace that. How do we turn our product into a data tool? How do we have our merchants go into the platform and say, wow, there's a network of data there where it's valuable for me to understand the difference between what I'm doing versus somebody competitive to us. So we're putting a lot of money and energy in our R&D into really making this a data product as well, not just a marketing product. So that's what's kind of the future is for Ackroo in the middle of this whole, strategic option exploration that we're going through. Here's a snapshot of our customer base. Again, it's very North America heavy, and I even want to give a snapshot of what we acquired versus what we won organically. You can kind of get a feel of where the success sort of came from. It was very, very vast across North America. We do have merchants in all segments. Our large merchants for us is those like 100+ location merchants is typically what is in the large segment. The 3 to 100 merchants is that client portfolio up for us. We actually divided our merchant base into clients versus customers over the last 2 years. So our customers are the 1 and 2 locations that are kind of low touch, no touch through our support team. And then our 3+ locations are our client portfolio that has high touch sales, client success people that support them as well. So what we continue to sort of add more of these small mom and pops, but really where we cater well to and we bring the most value to is that mid-market 3 to 100 location-ish kind of merchant base where our product does a lot for them, great revenue return for us, but also great value for them in return. The play is really partnership in our industry. It's really a game of integrating. There's a lot of players that play in this. Again, what I saw in the first 2 years of the company, I'm like, wow, there's a lot of players here. This industry just seems so ripe for consolidation. I've got to get into it deeper than I was. And so as you can see, it's constant partnership acquisition that's happening. And it's very fragmented. You've got specialty players in all different segments and what have you. And there's this constant consolidation that's happening aggressively of offering an industry that we're trying to get in the middle of as best we can. From a share structure and ownership perspective, I think on the beginning of this, Trevor had mentioned we have about 115 million shares issued. There's 8 million options issued and 123 million fully diluted. So the market cap was 9.5 million, fully diluted, call it 10. This is again based on March 1st, but we're very tightly held. Between board, myself, I own about 10% of the company, and a couple other of our board members have about 4 or 5% each themselves. Then you've got a number of other insiders that are kind of closely knit to the company. Almost 70% of the share capital is I can count on one hand, right? So there's really big blocks of shareholders in Ackroo, which is tightly holding it. So the float isn't very big. So when there isn't a lot of excitement or awareness, then you don't see the stock really move very fast or very far. But at the same time, when there is, you can see a big move in the stock. So again, only about a 30% float in Ackroo at this stage. This is our senior leadership team across operations and product and engineering and finance. Our board of directors. I thought it wouldn't hurt to talk about some of our priorities this year. We kind of have 5 big ones that we talk about in the business, and the number one priority is really about, cash and EBITDA management. How do we keep EBITDA as high as possible? We're aiming for a 25% plus EBITDA year this year. And so how do we maintain that? Pay off the debt that we have is the number 2 priority. We have $3 million of debt with BDC, and that loan is coming due in July of this year. We've already worked out a payment plan with them for now, but we want to be able to chew that down even more aggressively than the payment plan that we've discussed with them. And so how do we have as big of earnings as possible to both pay down the debt and to do our next acquisition? The third is acquisition efficiency. We know we like doing a deal every year. We just did our last one in December. The next one will most likely happen in the second half of this year. So how do we move on to the next one? We have to get really efficient at integrating and optimizing those businesses, getting them as normalized as quickly as possible so we can get on to the next deal. So it's really getting that efficiency going. So there's a lot of normalization happening. I think our Ackroo business is a big opportunity that we really haven't done a great job of monetizing. Only 5% of our revenues today is payments. And if you look at companies out there like Lightspeed and other public companies that are out there that have really embraced payments, it's a massive part of the revenues. Almost half of the revenues, I think, is Lightspeed's makeup now. So how do we sort of take the same approach? How do we go from 5% even to 10%, which isn't a big jump for us from a portfolio standpoint? So we're putting a big focus on cross-selling payments. There's no technical strain when we do that because there's no technical things that we have to build. It's really we're reselling other people's payments products. But it's a great revenue stream to help us influx capital into the business to keep expanding from further and further. And the last is really retention and expansion. I tell the company here we're retention first, expansion second, acquisition third. That's kind of our business priority. So how do we do a better job of retention? Take that 10% attrition rate down to like 3% like it used to be before COVID even happened. That's how low we were, 3 to 4% attrition rate like we were before. How do we get back to there? Which is bringing more value to our businesses. And then how do we provide expansion, which means cross-selling solutions, which I believe will also help with retention, and then work on acquisition, whether organically or inorganically. So those become our main priorities as our business. So that's kind of a quick snapshot, Paul, of what we're thinking about and what we talk about in our business. Hopefully that gives you a bit of an update as to what we're up to and where we're headed.
That's great, Steve. Appreciate that. One question came to mind is you've been doing it now for a number of years. I mean, it seems like the business is on the right sort of rails right now. What challenges do you continue to face, or what new challenges are you seeing in the business right now?
I still think I always say the 2 things I lose sleep over at nighttime is people and speed. I think there's still a people challenge. The people challenge has been hard for Ackroo, kind of for 2, maybe 3 big reasons. For those that don't know, we moved our head office from Ottawa to Stony Creek / Hamilton, where I live here, at the end of 2019. A few months later, COVID happened, and we made the decision to move here, build a nice big office, replace all the staff locally here, and build things out. But that was hard when it was all done virtually. We've still had a hard time with like the people side of the business, getting the right talent in place. Even when you get the right talent, there's a lot of turnover. We've had a wrestling with remote versus in office, and getting that, startup culture back and that excitement and that vibe back in the business. So the people struggle has been hard. And that's still something I, wake up at night, cold sweats sometimes trying to get it right. And then the speed, I feel like you can't move fast enough. You can't really, whether it's the product, whether it's the opportunities, the acquisitions, and even these strategic discussions, like how fast should we move, right? So these are the 2 things that I spend a lot of, endless nights on, is the people and the speed of the business.
Now you mentioned, within 24 hours, you expect some sort of transaction. Who, and I assume you mean like somebody's going to look at buying you. Who buys a business like this?
Well, so for us, there's a few. Like it could just be privatization.
Right.
We've discussed exploring privatization of the business, and you've probably seen a lot of microcaps that it's starting to happen to.
Yeah.
We're having discussions about it ourselves, right? Where maybe it's better off that Ackroo does, get a nice premium to market, takes the business private, and keeps executing under just a different ownership umbrella. The public market hasn't been a great benefit for us, especially the last few years. Even though I mentioned earlier about the public currency's been good for acquisition, the other side of it hasn't been great because we don't have this stock that's at a premium that we can leverage it in a meaningful way. So we have to be very careful with our stock. So private equity is one scenario that we've been discussing and exploring. There's direct competitors that are bigger than us that have been talking to us for quite some time. seeing that, us rolling up into them and helping them with their roll-up strategy. There's several guys that have tried to roll up and they just haven't been as successful as we have with it, that we could bolt into their world. And so a direct competitor is definitely those that are talking to us as well. But there are some complementary companies where, and it's not as much, but there's complementary companies that are out there too that are looking at us saying, wouldn't it be interesting to, come in and bolt on the Ackroo product instead of, partnering into that ecosystem. But this goes back to like, will we move the needle? So we've been chasing a $10 million revenue, $2 to $3 million EBITDA goal, because we feel at that dollar amount, 10 and 3, it moves the needle for somebody, right? Or more, that those complementary companies become much more viable to us. Whereas today, the ones that are really knocking on our door heavily are private equity or privatizing us and direct competitors.
Gotcha. Remind everybody, if you've got a question you'd like me to ask Steve, please just use the chat function and I'll ask the question. I mean, you talked about some of the challenges. You talked about people. We keep hearing that over and over again, just, managing people or getting good quality people. The fact you're public, the fact that you don't necessarily need to go back to equity, like what is the investor out there not getting right about the business? Like what is you're call it a $10 million market cap company, which in the grand scheme of things is still very tiny.
Yep.
But I'd almost say like perfect for a retail investor. Where do you think the disconnect is for investors right now?
I don't think people realize how safe the investment is in that respect, right? Like business is safe on one side, where like we're stable, we've got our operations under control, we've got earnings, we could even generate even greater earnings than we already have. So it's a safe investment. How big of a return is the unknown, but it's certainly a safe investment with regards to what the business is at. We're not in that fragile state anymore, where you have to worry about sustainability and longevity. And there's a potential of upside. We one or two big deals that happen and unloads things. Maybe the organic thing twists. Maybe an acquisition that is highly strategic pays a very big premium for us, right? So I don't think investors realize how stable and secure we've actually gotten this business. I think they may look at us quickly, Paul, and think that we're still a little bit fragile and maybe it's still they haven't figured things out, but we're actually a very stable business, more so than our size represents.
No, fair comment. I think I'd agree with you there. So I've got a question here. It relates to the synergies. Like when you buy these sort of companies, where do you get either the synergies or where is the cost cutting opportunities that you have with these type of businesses?
Well, the first is people. From an operational standpoint, we have staff here that can operate because we're buying similar businesses. We're not buying businesses and they run independently to us. Why we divested of GG Golf is because we kind of got forced into this separate business and it was more expensive. So part of the divestiture was not only was it not growing, but it forced us to have separate operations, which isn't our business model. We can have single operations. I don't need additional finance people. We don't need additional technology people. Like we have engineers and what have you. So there's a big efficiency on staffing. So that is the number one area of redundancy. Second is that there's, if you look at some of the deals we've done, they've got other hosting fees. We don't need to have separate hosting. We have our own platform, right? Other tools. We don't need separate facilities, right? So there's an operating expense side of it that's much leaner through us as well. So there's a lot of synergies heavily through people and also through technology integration that reduces things. And you'd be surprised about partnerships. You'd be surprised around actually two things. One is the deals in which they do because they're small, so they don't have a lot of leverage. And two, they build their businesses around a couple key merchants that kind of control them. And they take over their business because when you're small, you're going to do whatever you can to survive. So your biggest merchants, you'll do anything for them.
Control you. Yeah.
They come into our world, we don't allow that control to happen. So we kind of are able to break down things like that and don't allow ourselves to become this big services company. So I don't need 5 people to service 2 clients. We force them into our model or we move on from them. And we fired merchants because of it, because they had to fit the model. We were not starving for every merchant. We're starving for the right merchants. So we kind of even purge even the merchant base to get the right fits. And I think that's a bit of what's different, where some of these businesses are overspending to even support some of these custom clients of theirs. We don't do that.
You know, Steve, you've been a steady acquirer. Correct me if I'm wrong. There's not much in terms of R&D that you do for new products, but is there any other new initiatives or anything new that you're doing? Any other new products, new geographies, new something? What, if so, what is that?
I think the new ones are like a lot of our engineering advancement is through acquisition parity.
Mm-hmm.
We buy something, and a part of why we buy it, we see something kind of interesting around a feature or a function. An example is Simply Connect a year and a bit ago. We love petroleum as a vertical. I'm personally the believer that gas, grocery, and pharmacy is the holy grail of loyalty because it has that whole recency, frequency, and value proposition there. So we love the gas station vertical. We do well there. Simply Connect was interesting for us because they were in the US market, had integration to the two largest point of sale providers into gas station chains in the US. We now have that in our core product. So now we can actually go and sell our product throughout the US into gas stations, whereas before we could not. So that was big for us. They also had integration to the tobacco companies for brand loyalty. So they get all these rebates back into the actual convenience stores for buying things like tobacco. So we're just, tipping our toe in the water there, where our mobile app now for gas stations, not only is it do rebates back to tobacco companies, which effectively pays for the software, but also does ID verification. So it checks that you're 21 years old in the States. So you can actually make sure that they're of age and what have you. So there's these really interesting advancements that we would never have done organically that acquisition forced on us, where suddenly, how cool would it be to bring that back to Canada now? Can we bring back ID verification? Maybe it's for alcohol as opposed to tobacco, right? And can we do brand loyalty? Maybe instead of tobacco, it's Pepsi, right? Like whatever ends up being. So there's interesting opportunities there that, again, as we march forward, as much as we're acquisition first, there is an organic thing that's kind of happening. And at some point, one of these advancements should really, like, I always give the example like a fire hydrant. At some point, the turn will make the water flow. And that's an example of an interesting one that we're working on right now.
Gotcha.
Yeah.
So as investors looking at the business right now, and looking forward, what do you think the catalysts or maybe even some metrics in the business that we should really pay attention to know that you guys are executing?
Well, earnings is the number one story that I
Sure.
think we have to look at, right? It's revenue is nice at Ackroo, but it's an earnings story here. Like, are we continuing to increase our earnings, which shows that A, we're integrating quickly, we're keeping costs down and generating cash flow to both buy back shares like we did last year, or to pay down debt, which we did last year, or to buy companies, which we did last year. So really, it's watching our ability to generate earnings is the thing, and our continuous ability to do that, and then see what we do with that capital. Like, how are we using that money? How are we using those earnings to kind of, again, buy back shares, pay down debt, buy more acquisitions, and do our creative deals that we're doing? So I think that's the main, the thing to keep looking for is our earnings contribution to the business.
And I mean, you touched on something that I should have really asked earlier. You had mentioned that obviously the goal is to pay down debt, but are you looking to continue to buy back stock? Obviously, you're still an acquirer, so you're going to be doing that. We always try to ask, like, what's the real allocation of capital look like going forward?
So for us, plan A is, we renew in June. You can only buy back 5% of your stock, and we bought back the whole amount we could last year. The plan is to do the same again this year, right? How do we continue to go down, assuming that our stock is still as depressed as it is? So if the stock is depressed and it's the best use of capital, which we felt it was at the time, we will continue to do it again. So today, the plan is to continue to do another NCIB next year to do more buybacks. It's also to pay down the debt. And there's deals in the hopper that through creative financing, we can kind of get done through our own capital and earnouts and what have you, like we've done in the past. But yeah, there still is a plan to do more of it. I think it's a smart move. I've seen a lot of people in our position do the same. And at this stage, why not? If we're generating cash, it's a good use of capital, in my opinion.
Yeah, no, I think the majority of the companies that we've seen do well over the last year or two have been companies that have been able, they're in a position to buy back stock and take advantage of the low prices.
Yeah.
Steve, I've sort of run out of questions, so that means you did a good job as a presentation. But is there any key takeaway, any key message you want to make sure everybody walks away with today?
I just think it's we are going to try to spend a bit of time getting our story a bit more out there than we have. I'm going to try to attend a few events this year to kind of create more awareness of our progress. I think the big message again is, watching continued execution. I'm going to talk a bit more about what we've done with our acquisitions so the market's more aware I feel like we've talked a bit, maybe too much about our organic business and not enough about what we've done inorganically, because it's really an inorganic story here. So I'm going to spend a bit more time in future press releases on what we've done there. So that earnings and acquisition story. So continue to read the press releases and the things that we're doing in that nature. And I think people get a better understanding of the business and even get more comfortable with what we're up to and where we're headed. Because I think that's one of the biggest missing links, is that it's the misunderstanding of how we're evolving our business and how stable and secure we really are.
Well, I mean, you got a sub $10 million market cap company right now that's profitable and growing. That's a pretty rare beast in the marketplace. So I think worthy of everybody keeping a close eye on you. Steve, always great to chat. Thank you for joining us today, and we certainly look forward to catching up in the near future.
Awesome. Thanks, Paul. Thanks for having me.
You bet. Cheers.
Cheers.